Hello, my dear 12B. Hope each and every one of you is doing great and everything at your place, at your home is also going good. I know, things are getting extended and we are not being able to go out. But then, one good side of this is that you people are really getting the quality time to prepare yourself for the exams, isn't it? So, carrying forward from where we ended last time, I would be taking up guarantee of profit today. So, you can go to your page number 1.75 of your textbooks, and we take up the fourth segment of this chapter, guarantee of profit. There you will be finding a first paragraph written where a partner may be guaranteed minimum share of profit from the business. So where there are two or more partners we already know in a firm. So where the other partners or the firm itself somehow one of the partners is being, or one of the partner or the partners is being guaranteed that okay, you will be getting this minimum amount of money from the business after the financial term. So what we are going to study is under this subtopic, that is how the partners are being guaranteed a share of their profit, because many a times partners are a little orthodox, they are rigid, and they are very very particular about like however or whatever the business does, I should get this particular amount of money. So in such a case where you are too much dependent on a partner, you want him or her to join your business, and at the same time that person is putting a condition that if I don't get this particular amount of minimum money as a return, I wouldn't join. So in such a scenario, in order to get your that partner be a part of the business, you are ready to extend any sort of incentive. So that leads to this segment of our chapter, which is called as guarantee of profit, as the name suggests. Now see, on that particular page, like you've already opened up page number 1.75, you will see there the profit may be guaranteed to an existing or incoming or new partner. As I said, either a good partner, a very eminent partner is already there in your business, or you want somebody to join in your business whom you want to join at any cost. So what are the various ways? By all the partners, all the remaining partners in an agreed ratio, or one or more of the existing or the old partners. So that's already written in your book, of which the first topic, first subheading under this topic is guarantee of profit by all the remaining partners. So when you're letting another partner come in, or already an existing partner is wanting guarantee of profit, the other partners give a commitment. Okay, fine, we'll all contribute to that minimum profit that is supposed to be given to that partner. What are the steps? Number one, like see, it's there in your textbook. Step 1, share of profit as per profit sharing ratio is determined, and step 2 is minimum guaranteed profit is determined. So let me take up a problem, and I think things will be done. On the same page itself, there's illustration number 49. If you can see, partners Anand and Chetan, and like there are three partners, isn't it? So Anand, Basu, Chetan. So what is happening? It is they are sharing profit in the ratio 4:2:1. It is provided that C's share in the profit would not be less than Chetan's profit would not be less than 37,500, and then they've got year ended profit to be 1,57,500. Now I've just read out the sum. The facts remaining same. Names could be different in your textbook, like we have done the previous sums also. You can go ahead with this. So data given to us is that the third partner is guaranteed a minimum profit of 37,500, where the firm has earned a profit of 1,57,500, and that is supposed to be divided amongst the partners in the ratio 4:2:1. Now if you go by the stereotyped calculation of profit sharing ratio, that should be the basis of division of profit amongst the partners, we can find that share of profit to all the three partners would be under that ratio, where the third partner will be getting 1/7 of that particular profit, which is 22,500. Now see, the third partner is guaranteed 37,500, whereas technically he should be getting 22,500. So there's a shortfall, there's a deficiency. You deduct the values and you get the deficiency amount. Now what will we do? Where the firm has earned 1,57,500, the third partner is guaranteed 37,500. You can see the working note, the explanation given down. It's all that what I'm explaining to you. So once you deduct that third partner ka guaranteed profit 37,500, what you're left with is the balance figure, which is coming to 1,20,000. Now What are the other two remaining ratios for the first and the second partner? That's 4:2. If you reduce down to much more simpler forms, it is 2:1. So over here, that remaining 1,20,000 would be divided amongst the first and the second partner in the ratio of 2:1. So that's coming to 2/3 of 1,20,000. For the first partner, that's 80. Second partner will be 1/3 of 1,20,000. So that's 40. So in that ways, all the three partners will be getting 80,000, 40,000, and third partner will be getting his guaranteed amount of 37,500, right? The other option is on page number 1.77. You will find guarantee of profit for one or more of the existing or old partners. Nothing much different. It's almost the same thing that we've just gone through. You just give it a reading, and the steps are being saying distribute the profit. If the share of the profit of the guaranteed partner is less than the minimum guaranteed profit, then the difference is deducted and shared by the other partners who guarantee it. So it's almost the same. It's just that I want to discuss a particular problem which is solved in the way of journal entry, and that's the reason why I take up 1.77 and illustration number 52. The other three partners are Pal, Jaya, and Raj. Now, they are partners sharing profits in the ratio 5:4:1. Those who have got the older edition, you will find partners name to be PQR. It could be something else also. Always relate to the data that I'm saying. So profit sharing ratio is 5:4:1, and here it is said that Raj, or the third partner, is guaranteed his share of profit in any year will not be less than 50,000. So the minimum guaranteed is 50,000. Now the firm is earning 3,50,000 and ratio being 5:4:1. If you see the working note, it is said that if it is 5:4:1, then the third partner is supposed to get 1/10 of 3,50,000. That's coming to 35,000. Right, whereas the minimum guaranteed profit is 50,000. So what is the deficiency? How much is the shortfall? It is 50,000 minus 35,000. So that's coming to 15,000. So the other remaining partners, the first and the second one, that's Pal and Jaya or P and Q, they will be sharing that deficiency, that shortfall of 15,000 in their own a certain ratio. Now, how do we calculate that ratio? If you see in the working note itself, it is written that Pal and Jaya will be sharing it in the ratio of 3:2. And where did you get the ratio? Check out the sum. The last line clearly says that whatever shortfall will be there in the profit of the guaranteed partner, that will be borne by Pal and Jaya in the ratio of 3:2. So 15,000 will be divided in the ratio of 3:2. They will be contributing as 9,000 and 6,000 out of that 15,000. And how will you solve that in the form of journal entry? You will be solving it as first and the second partner, those who pay the money, their capital accounts are always debited, and that person who receives the money, or the persons who receive the money, their capital account is always credited. So over here it will be Pal's capital account debit, Jaya's capital account debit to Raj's account, 9,000, 6,000 credited to 15,000. I'm sure you must have understood. I have just read out and explained whatever is there in your textbook. That shouldn't be a problem. If you're through with this, if you understood these two mechanisms, you need to go to page number 1.80, illustration 57. That again is a full-fledged sum like you would be getting in your ISC examination or the school exams, like guarantee of profit by a partner. So we've already discussed both the forms of that. You will be going through this illustration, and I'll be happy if you do not refer to the solution and try and solve out the sum. It's just what we have discussed just now in the last two problems. After that, you would be coming to page number 1.82. Now all this while we have found out that the firm is getting a profit and the partners are trying to contribute to the guaranteed partner when the firm is in an advantageous, is in a favorable position where it has already earned profit. We will be taking up a scenario where the firm has a loss, already at a loss, and yet there's a partner who's been guaranteed. Now, how do we work that out? What are the steps? Number one, distribute the loss among the partners. Obviously, when the partners are supposed to enjoy the profit earned according to a particular ratio, loss also has to be borne accordingly. So over here, the first step is first distribute the loss. Then the second step is capital account of the guaranteed partner will be credited with that guaranteed minimum profit, and whatever that extra burden comes out to be in the form of money, that will be borne by the other remaining partners. So in the same way, right? Let's see. We will be taking up, come to page number Come to page number 1.83, and that should be illustration 60. Okay, that's ISC 2015. If you see, there are three partners: Rohit, Ali, Sneha. Profit sharing ratio 2:1. Interest on capital, interest on drawing, salary is given, and the fifth adjustment says Ali's guarantee to the firm that the firm would earn a net profit of at least, correct the spelling there, it's written at least, make it at least 80,000 per annum, and any shortfall in such profit will be met by him personally. Isn't it? So over here the capitals of the partner have been given. Within the financial year, the three partners have withdrawn 1,000 each at the beginning of the month, and the net profit of the firm is 70,000. You're supposed to show PL APRO account and partners capital account. So what we are going to do is, if you see the solution there, the profit is transferred 70,000. I don't need to teach you again. You already know how to distribute interest on capital, how to distribute salary, and how to calculate for interest on drawings. What we will see is, if you see the note after PL appropriation account, it says Ali has personally guaranteed the firm will be earning a profit of 80,000, so 10,000 is deficiency. Obviously that is supposed to be contributed to the firm, and I've always said whenever a partner contributes, his capital account is debited. Whenever a partner receives, his capital account is credited. Ali is contributing the deficiency of 10,000, so check out PL APRO account. There on the credit side you have by Ali's capital account, so that's Ali's capital account is debited. That 10,000 is contributed into the firm, and finally yielding a profit of 55,385. That would be divided in the ratio of the given ratio of profit to be 2:1, and that comes to 22,154 each in case of Rohit and Ali, and Sneha will get 11,077, and the corresponding effects will be placed in the partner's capital account. Right now, that is an important sum. That's an ISC sum. You can mark that, and then you can come back to come to page number 1.86 with illustration 63. See, minimum earning guaranteed by a partner to the firm and minimum profit guaranteed by a firm to a partner. So both have been discussed. In that particular illustration, you will find there are three partners: Daksh, Moksh and Yash. In the older book, it would be X by Z. In the ratio of 3:2:1, Z's share or Yash's share of profit is guaranteed not to be less than 30,000 per annum. And Y gives a guarantee to the effect, or the second partner, basically Moksh, is giving a guarantee to the effect that the gross fee earned by him for the firm shall not be less than the average gross fee earned by him during the preceding 5 years. Nothing to worry. I'm just reading out whatever is there written already in your book, the average of which works out to be 50,000. Let's see how have they worked it out. I first want you to refer to the working note. Please come see. Profit for the year ended for the partnership firm. These are three CAs who have actually tried to set up a firm. So profit for the first year of the partnership business is 1,50,000. Now we are going to add the difference between the guaranteed fees to be earned by Moksh and the actual fees earned. See, actual fees earned is 32,000, guaranteed was 50. So 18,000 is the deficiency. Now, whatever profit has been earned by the firm, 1,50,000, you will have to add back the deficiency. So that's coming to 1,68,000. Now, projected gross fees of the firm is 1,68,000, which is supposed to be shared amongst the three partners in the ratio of 3:2:1. And that has been already worked out for you in the working note, coming out to be the values of 84,000, 56,000 and 28,000 for all the three partners respectively. Now what Yash does is Yash was guaranteed, that's point number 2 under your working, a minimum sum of 30,000. Hence the deficiency of 2,000 will be borne by the first two partners in the ratio 3:2. See, out of that total minimum sum guaranteed, out of that 30,000, see, what is happening is the third partner is already getting 28,000 according to the calculation, but he was Yash was already guaranteed 30,000, so 2,000 is deficiency. That will be borne by the first two partners, Daksh and Moksh, in the ratio of see, over here it's given 3:2. And how do you get 3:2? See the sum. The sum already gives you the ratio 3:2:1. So obviously that 3:2:1, the first two partners are getting is as 3:2. So that's coming to 1,200 and 800 for the first two partners. You will be adding that with the third partner's share. So 28,000. Check out the last line. 20,000 plus 1,200 plus 800. You're getting 30,000, and the other two partners are already getting. Now when you go back to the PL APRO problem, there are no other adjustments given rather than distribution of profit. So we will be transferring the net profit 1,50,000. I told you the partner who contributes the deficiency, in this case it's the second partner Moksh, so he'll be contributing 80,000. So that is posted in the credit side as by Moksh's capital account, and whatever our calculation of final distribution of profit is, that has been written in the debit side as 82,800, 55,200, because from the original values 1,200 and 800 will be deducted for the first two partners, and finally third partner will be getting 30,000. So with this, I will almost be concluding today's lesson. After you have gone through these problems that I have discussed, what you'll do is on page number 1.84, illustration 61, that is about IAC sample paper, Rahul Shiv Kabir, and then go to page number 185, the last sum under this topic, where the partners are Anu, Bhuvi, Chavi and Disha, with a profit sharing ratio 4:3:2:1. That's illustration 62 on page number 1.85. Like we did for the previous topics also, you will go through these two illustrations, check out the solution, you will refer back to my explanation and the problems that we have discussed. I'm sure you will be able to draft the PL appropriation account and journal entry wherever required, and once you go through the solution, close the solution, don't refer to it, try and work out the sum at your place, isn't it, on your own. If you get stuck somewhere, you can always refer back to the solution, because the book has already provided the solution to you. Mark illustration number 61 as important. That's an IAC sample paper question. You will also mark that chartered accountant sum that I said, Daksh, Moksh and Yash, mark that as important. So that was illustration 63, and illustration 60 also, which is IAC 2015. Right? I will be concluding my class lecture here today. Please stay safe, not to worry. I know we all are a little, getting bored at home, not being able to go out and meet our friends, not being able to go to school, but for a bigger cause, for humanity, we have to do this, isn't it? But at the same time, I repeat, my dears, I told you we've been granted a quality time to concentrate and go and cover up or do all our work, whatever is required in its pioneer form for our IAC preparations. So don't lose heart. Please work out the problems, and till the next time when I'll give you my further lectures, please cover up all the work that is being done, and I'm sure you are working out the assignments also which are given to you. I have already given you the solution, so you will always refer back to the portions that we've discussed, to the solution, and keep up yourself well versed and known with the portion of accounts that we are doing. Thank you, my dears. Take care and hope to meet you soon. Bye bye.